Hello everyone, welcome to the 26th episode of me learning how to trade using Forex. So in the last episode we went through Andrew's pitchfork lesson in the advanced technical analysis course on forex.com, and today we're going to start doing the average true range lesson. So let's get started. So average true range. The average true range indicator is popular among technical traders as a means of quickly identifying market volatility. Let's take a look at how it works. So, average true range indicator is popular among technical traders as a means of quickly identifying market volatility. What is average true range? Average true range is a technical indicator that appears as a single line in a box beneath a market's chart. So average true line, average true range appears as a single line in a box underneath a market's chart. When the line rises, it means that the market is becoming more volatile. When it drops, volatility is falling. If the line rises, the market is getting more volatile. If the line drops, the market is getting less volatile. So we get this, and then average true range is in the middle, somewhere here. In this USD JPY chart, average true range remains below 1.4 as it pairs these relatively small price movements. Then as USD tumbles against the JPY in October, it rises new highs. Well, I'm glad on this chart here it shows you exactly where October is. It rises to new heights. So these two lines are not the same, no? Average true range appears as a single line in a box underneath the market chart. So this is all the average true range. When the line rises, it means that the market is becoming more volatile. So this is the line. So as it rises, more volatile. It rises new highs. Yeah, okay. ATR was originally invented for use on commodities, but traders now use it across multiple asset classes. Calculating average true range. Much as the name suggests, average true range is a moving average of a market's true range. To calculate true range, you need three figures: the current market high minus its current low, the current high minus previous close, the current low minus previous close. So, much as the name true is a true range indicator that appears popular amongst technical traders. So let me just write here. It's a moving average of a market's true range. To calculate the true range, you need three figures. you need 3 figures to calculate true range. 3 figures are needed. The current market high minus its current low. The current market high. The current market high minus its current low. The current high minus the previous close, and the current low minus the previous close. Whichever figure is greatest out of the 3 is the true range. Whichever figure is the greatest out of the 3 is the true range. For example, let's say that the DAX hits a high of 13960 and a low of 13926 in today's session, after previously closing at 19335. So current market high is 13960, minus its current low 13926 is 24. The current high 13960 minus previous close 19335, and the current low 13926 minus previous close 19335 minus I. The greatest figure of the 3 is 34, so the high minus the low provides the current true range. It doesn't matter that one of the figures is negative. ATR takes the highest absolute value into account. Takes the highest absolute value into account, so that's basically a 9 then, B. So if that was basically like minus 50, then that would be the average true range, which is 50. It doesn't matter because it's absolute, so it doesn't matter if any figures are negative. The highest absolute value is used. By default, the ATR indicator takes the true range of the last 14 sessions and converts it into a moving average, which is shown as a line. As with most indicators, you can tweak it to include as many sessions as you want. Short-term traders often use ATRs of 10 sessions or fewer. Right, okay. Trading with ATR. As a measure of volatility, ATR is frequently used to evaluate opportunities, including whether to trade and where to place stops and limits. Should I trade? Average. Used to evaluate opportunities. Including whether the trade this includes I trade this includes should I trade. Using ATR, you can quickly see how much a market typically moves in any given day. Can use average true range to see how much a market typically moves in a given day. In any given day. This can be useful when deciding whether to trade a signal provided by another indicator. This can be useful when deciding whether to trade a signal provided by another indicator. It can be useful when deciding whether to trade signal provided by another indicator. This can be useful when deciding whether to trade a signal provided by another indicator. So if you're using another indicator, then you can use this ATR alongside that to see whether that opportunity is actually worth trading, because you can see how quickly the market moves. So I think that's what it means. For instance, ATR might tell you that a market only tends to move 20 points in a given session. If you spot a sell opportunity but the market has already dropped 25 points, you might want to reconsider trading. ATR might tell you that a market only tends to move 20 points in a given session. If you spot a sell opportunity but the market has already dropped 25, you might really want to because it's dropped below that 20 points, so it won't be a good opportunity to trade. I think that's what it means. Stops. Similarly, ATR can be used to determine where to set profit targets and stop losses. So you can use true range to determine where to set targets and stop losses. If a market moves 20 points each day, then targeting a 50-point profit from the current session might be unrealistic, because that would be like 3 days worth of trading. This also helps with setting stops if a market is more volatile than usual. You might need to place a stop further from the current price to avoid getting closed out early. Place the stop further away from the market price to avoid getting closed out early. However, remember that this will increase your overall risk. Cool. Average true range fact sheet type indicator used in any conditions, used for measuring volatility, evaluating opportunities, markets any, time frames any. Very good. Go to the next lesson. Ichimoku clouds. The final indicator we're going to look at in this course is the Ichimoku cloud, which is useful for getting a quick idea of trends and directions, as well as helping to gauge overall momentum. What is the Ichimoku cloud? The Ichimoku cloud is a technical indicator that's formed of 5 lines on a market's chart. Final indicator, Ichimoku cloud. Ichimoku. Ichimoku Ichimoku cloud. Is useful for getting a quick idea of trends and directions, as well as helping to gauge momentum. What is the Ichimoku cloud? The Ichimoku cloud is a technical indicator that's formed of 5 lines in the market's chart. Formed of 5 lines on a market's chart. The Tenkan, not Tankan, Tenkan, Kijun, Senko, Span A, Senko, Span B, and Chiku. The gap between the Sengoku span A and B lines is shaded in, which is how the cloud is made. Create the clouds. Let's just grab a quick screenshot of this. Okay, so we can see that clouds are here, clouds are here, clouds are here. I'm assuming that's what they mean. Ichimoku was invented by a Tokyo newspaper in the 1960s. It may appear confusing at first, but once you grasp the basic concepts, it is relatively simple to use. In Japan, it's referred to as the one-look equilibrium chart because of the amount of information it shows. Right, okay, so drawing the clouds. Learning how to use Ichimoku. That's a nice spelling mistake there. First of all, you need to know what each of the lines represents. Let's start with the Tenkan and the Kijun, also known as a conversion line and baseline. So you didn't know which line represents. The Tenkan. The Tenkan line is the market's 9-period high status. Oh, actually, let's just do it on the new lines. Tenkan. The Tenkan line is a market's 9-period high plus its 9-period low divided by 2. Tenkan, markets 9-period high plus its 9-period low divided by 2. Kijun is the market's 26-period high plus its 26-period low divided by 2. Period high plus its 26 period low divided by 2. As you can see, the Tenkan gives the midpoint of the 9 period high-low range, whilst the Kijun does the same for the 26-hour period range. Gives the midpoint of the 9 period high-low range. Gives the midpoint of the 26 period high-low range. Once we know these two lines, we can draw the upper and lower boundaries for the cloud itself using the Senkan span A and B. Also known as a conversion line baseline. So Tenkan, which is conversion Kijun base. Right. So Senkan span A, also known as the upper boundary the Senku span A is the Tenkan plus the Kijun. Tenkan plus Kijun divided by 2. This is the top of the cloud. Top of the cloud. This is the top of the cloud. Senkan span B, lower boundary, is the 52 period high plus a 52 period low. I thought it was 26, how come it's 52 period now? However, the cloud isn't drawn on today's price, instead you plot it 26 periods in the future. Ah, right, okay. So, 52 period high plus 2 period low divided by 2. This is the bottom of the cloud. However, the cloud isn't drawn on today's price. Instead, you plotted 26 periods in the future. Cloud isn't drawn on today's price. Instead, you plot it 26 periods in the future. Finally, the Chiku is today's close, plotted 26 periods in the past. Trading with the Ichimoku. Today's close, plotted 26 periods in the past. Plotted 26 periods past. Trading with the Ichimoku cloud. The relationship between these lines can quickly tell you a lot about the market. When span A is above span B, it is usually a sign that the market is in an uptrend. Right, okay, so A is above span B, market is usually sign that the market is in an uptrend. In this case, the cloud is usually colored green and may be more likely to provide support on any pullbacks. Cloud is usually colored green and may be more likely to provide support on any pullbacks. Double comma when if span B is above span A, the cloud will be red. Cloud is usually colored red, and the market may be in a bear trend. The cloud serving as potential resistance area to watch. Cloud is usually covered red. A bear trend. Cloud serving as a potential resistance area to watch. Wait, but this isn't red though. This is like purple. And that's green. Huh? Plus the cloud offers further clues as the momentum of any current market. Plus the cloud offers further clues as the momentum of any current market condition. What? Okay, in a bullish market, for example, price action would be above the cloud. To watch. So cloud offers clues on the momentum of any market, of any current market conditions. In a bullish market, for example, price action would be above the cloud. If the Tenkan then crosses above the Kijun, it can be a further signal of upward momentum, especially if this also occurs above the clouds. What? Okay, so if the above can be a further signal of upwards momentum. Especially this also occurs above the cloud. Right. If the Tenkan crosses below the Kijun, meanwhile, then the bull market may be weakening. Maybe weakening. In bearish markets, the opposite is true. Price action will typically be below the cloud. Below the cloud. The Tenkan crossing below the Kijun. When both are below the cloud. Indicates a strong bear trend. The Tenkan crossing above the Kijun can signal that the bear market is weakening. The bear is weakening. As we noted above, you can also use the cloud to predict future areas of support resistance, unlike many other indicators that only give current areas of strengths and weaknesses. To predict future areas of support and resistance. So Ichimoku fact sheet. Type indicator used in any conditions. Used for spotting trends, predicting support and resistance, markets any, timeframes any. Cool. The Fibonacci theory. The principles of Fibonacci theory provide the basis for multiple different technical analysis tools, indicators, and strategies. In this lesson, we're going to run through the Fibonacci ratios, retracements, and more. But before we get onto that, we need to cover the Fibonacci sequence. What is a Fibonacci sequence? The Fibonacci sequence is a series of whole numbers where each figure is a sum of the two before it. It starts with 0 and 1, which are known as the seed numbers. The next is 0 plus 1, 1, followed by 1 plus 1, 2, and so on. Here's what the beginning of the sequence looks like. So 0 plus 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, 3 plus 5 is 8, la-di-da-di-da, and so on to infinity, out to infinity. That might look a bit confusing at first, but it looks much clearer when you include the maths behind each figure. Okay, yep, so it's just basically that plus that, that plus that, that plus that, that plus that. But the Fibonacci sequence on its own isn't hugely important to traders. Instead, it supplies some numbers for Fibonacci ratios. What are Fibonacci ratios? Fibonacci ratios are the series of percentages calculated by dividing figures among Fibonacci sequence. Fibonacci ratios. So, Fibonacci are a series of percentages calculated by dividing figures along the Fibonacci sequence. There are quite a few different ratios, but the key ones are 23.6%, 38.2%, 61.8%, 78.6%, and 161.8%. But the key ones are 23.6%, 38.2%, percent, 78.6%, 78.6%, and 161.8%. To see how they work, let's take a closer look at the maths behind the 61.8% ratio. So that's the third one there. To find the 1.8% ratio, all you have to do is divide each number in the fib sequence by the one that follows it. Do this along the chain and you'll quickly spot that it comes out roughly 0.618 each time, particularly from 21.3 divided by 34 onwards. Divide each number in the fib sequence by the one that follows it. So it's 1, 0, so 0 divided by 1 is 0, so 0 divided by 1 is 0, and then 1 divided by 1 is that, 1 divided by 2, 2 divided by 3, 3 divided by 5, 5 divided by 8, 8 divided by 13, 13 divided by 21, 21 divided by 34, 34 divided by 40, 55, 55 divided by 89. If we can then convert 0.618 into percentage, we get 61.8%. To find 161% meanwhile, you divide each number by the one that precedes it. So that's 0 divided by 1 is 0. Oh, it's 1 divided by 0 is 0, so that divided by that divided by that, 2 divided 1, 3 divided 2, 5 divided 3, 8 divided by 5, that sort of thing, yep. 61.8 and 161.8 might be the most important Fibonacci ratios of them all, also known as the golden ratios. 61.8% and percent are the most important Fibonacci ratios. Also known as the golden ratios. They appear frequently across maths, geometry, architecture, art, and more. You can find other Fibonacci ratios with other dividing patterns. Here are a few common variations. Divide by the second following, divide by the second preceding, divide by the third following, divide by third preceding. So 38.2, that's that. 0.236, that's that. So yeah. However, there's one other way to get the fib ratios, by finding the square root of an existing one. The square root of 0.618, for example, is 0.786. Convert that into a percentage and you get 78.6, one of our key ratios. Yep. Here are some other common ratios calculated using square roots. Fibonacci ratio, operation square root, result, square root result. 50%. There is another ratio that is commonly used in Fibonacci analysis, but isn't technically a Fibonacci ratio. 50%. It doesn't appear in a sequence, but like the key ratios, it often rises. It rises often in the markets. Some argue that the 50% ratio is a Gann ratio created by W.D. Gann in the early 1900s. Whatever the source, the 50% ratio seems to be a rather important relevant level when trading, so it's often included in technical analysis as if it were a Fibonacci ratio. Fibonacci retracements. But how can you use the Fibonacci theory in your trading? The most common way is through Fibonacci retracements, which traders use to predict support and resistance levels when the market retraces after a significant move. Levels after, when a market retraces after a significant move. Say for instance that Brent crude tumbles 150 points as part of a bear trend. You expect a counter trend form as buyers briefly arrest crude's fall. According to the Fibonacci theory, that counter trend may find support or resistance at the Fibonacci ratio of the initial move, often 23.6, 38.2, 61.8 or 78.6%. So 0% here, 23. You may find support resistance, so that's a resistance, and it also becomes support here. That's a support here, resistance here, and then resistance here, support here, I guess. You can add these ratios to any Forex.com chart using the Fibonacci retracement drawing tool. This automatically adds lines at key Fibonacci ratios and 50% on your chart. This is 50% right. So you can plot where a reversal may arise in an upcoming counter trend and project potential support and resistance levels in advance. This is all good and that, but it's just a bit random, isn't it? Having just like these 23.6%, 38.2%. After just like dividing by some numbers basically. Yeah, okay. Fibonacci retracement fact sheet. Type: drawing tool, used in retracements, used for finding support and resistance levels, markets any, time frames any. Alright, so, what's the time? Okay, so I'm going to leave this video here, and thank you guys for watching, and I'll carry on with the ABCD pattern in the next video. So, see you guys then.